generation of millennials who are not going to be able to find a home to buy. There's just not enough homes on the market.
Welcome back to Real Estate Mindset. Today's video is gonna be absolutely bonkers. Now, the data is in, and apparently last week Redfin was being overly optimistic about the housing market. Today's new report is a lot more cautious. They're now acknowledging that their housing market recovery may actually be on hold. Now, the predominant reason that is potentially a second round of inflation. Because there's a potential second round of inflation, because people are still spending like crazy, obviously what has happened in turn is the 10-year treasury has gone up, raising interest rates, making things much more unaffordable once again. So we're going to deep dive into Redfin's new weekly housing market update, and we're going to compare some week over week data just to see where we're at this week. And towards the end of this video, I'm going to do my peak versus current comparison. And I really try to drive home why price is so much more important than interest rate. So definitely stay for that part, guys. And don't forget, guys, I'm not your financial advisor. You guys already know that, even though my bio is as a realtor, loan officer, and instructor in all things real estate in Texas. So for all of that, guys, do me a favor and please like this video, comment below, subscribe if you haven't, and definitely hit notifications, because I don't know what's going on with YouTube, but a lot of people aren't getting notified that my videos are being released. So definitely, guys, if you can do me a favor right now, hit notifications. But either way, guys, we're going to jump into this Redfin article titled Housing Market Update, Recovery Stalls as Mortgage Rates Jump. So I'm only including 2 paragraphs from the actual article, y'all. This article will be listed in my description as always, because I know I'm just sharing with you my opinion, but I always want to source my data so that you guys can do your own thinking. Don't let me do the thinking for you. Don't let anyone do the thinking for you. You need to do your own thinking for yourself. So follow the link. It's in the description. But here's what this says. The somewhat disappointing inflation numbers put a wet blanket on home buyers after sub 6% rates lit a fire under them a few weeks ago. Inflation is cooling too slowly, and the job market and retail sales are too strong for the Fed to ease up on interest rate hikes, which means mortgage rates are unlikely to fall much in the next few months. That does not erase the progress we've made, doesn't it though? But okay, whatever. That does not erase the progress we've made, and it doesn't mean rates will soar past 7%. Okay. It is a reminder that the housing market recovery will remain touch and go until we see inflation and the overall economy improve for a longer duration. Okay, good. So a little bit more cautious, right? Because they have to be, because they keep getting things so wrong. I mean, you guys, it's crazy to me. They're salivating on being over optimistic. They can't wait to start cheerleading again. So, and you guys remember last week's, Redfin video. I mean, it's a flip flop, right? Do y'all agree with me? Are they flip flopping? Let me read this last part. The inconsistent nature of Redfin. I'm sorry. I apologize, guys. The inconsistent nature of the comeback is evident in the week's data, which shows that although buyers have taken a step back, they're still more active than they were last fall. Redfin's demand index is up 17%, low point it fell to this past fall when mortgage rates peaked at over 7%. Pending home sales also continue to improve. They're down 18% year over year, but that's roughly half of the 33% decline in November. Redfin agents report there's strong demand for move-in ready, well-priced homes in desirable neighborhood. So let me know what you guys think. Let me know if you think they're being overly optimistic. Maybe they're not being over optimistic. Are they being cautious? Let me know about your overall feeling about Redfin. Now, I believe they're flip-flopping like crazy. They're flip-flopping like Zillow. Just when I started to have faith in them, coming back to being cautious, they do back-to-back reports with a crazy amount of optimism. How can you possibly be so optimistic right now when ain't no one know what's going to happen? Right? We had a couple months of good inflation numbers, and look what happened, right? Look what happened. And the craziest thing of all, the Federal Reserve is literally telling us what they're going to do. And they do it. They're telling us literally what they're going to do. And yet the market and investors, they're still trying to fight the Fed. And when you go and you fight the Fed, history tells us that's never a good idea. And that's what we're seeing here. Let's move on. Here's this week's leading indicators. Now I'm going to do my housing market update video, I hope tomorrow, but I did guess it pretty much accurately. I guessed that the rates would raise to 6.3. They actually raised to 6.32. So the rates have gone up, but look at the daily average as of this report, or the 15th, 6.75. You guys, I'm telling you, people are getting 7% again right now. Right now, people are getting 7%. Now, mortgage purchase applications during the week ending February declined 6% from a week earlier. And here's the important thing to understand, because there's been so much cheerleading and over-optimism for nothing. Applications are still down 43% year over year. You guys, the applications are still down 43% year over year. Not to mention, investors are panicked and leaving the market. I'll have another video on that a little bit later. Let's continue. The seasonally adjusted Redfin Homebuyer Demand Index, a measure of requests for home tours and other home buying services from Redfin agents, was down 1% from a week earlier, but down 22% year over year. Google searches are also down 24% year over year, but we're up 35%. Again, they're not doing year over year. They're going from the low point, which is November. So they're up 35% from November, but down 24% year over year. Okay, guys, so a couple more indicators. Take a look at this. The median home sales price was $346,725. That's up 1% year over year. But I really want to point out, y'all, that we are down because remember, we peaked around June, just depending on the data, depending on the metro area, at about 390,000. So this represents us essentially being down if we look at the actual data, the incoming data, and we don't wait for year over year, because if we wait for year over year, we're never going to know what's going on in the housing market. And that's my gripe with all these people holding on to year over year. It's like, if you're going to do that, come back to me after a year and tell me what you learned. Because I'm looking at stuff that's happening right now, including MLS active data. Way more important, you guys, way more important, especially when we have quantitative tightening. But it is important to note that we're down right now, from peak to right now, 11% on average. We're down 11, not in Houston, unfortunately. My city is a little stronger, but we're down 11% on average. Think about it, guys. Now, I've defined a crash as 15%. That's my own personal description of a crash, although I think we're going to hit more like 20% decline on a national average. My call was a 15% to equal a crash. We're at 11. You guys, we're at 11 right now, and we're in the second inning. We're only in the second inning. Median sales price fell in 20 of the 50 most populous U.S. metro areas, with the biggest declines in Oakland, California. So we have 40% of the biggest metro areas on the year-over-year price decline list. And here's the thing, you guys. We have more incoming pain because the 10-year is shooting up. So how many more metro areas are going to hit that list, right? Probably a lot more, because, again, remember, incoming pain right now. But this is interesting. Let's look. Oakland at negative 9.3% year over year. And that does not include all of the equity that they've lost from peak. So you have to add to that 9.3% where they were at on the peak. Now, we also have Sacramento, followed by Austin, Phoenix, Detroit, but prices did increase year over year in Milwaukee, West Palm, Miami, Columbus, and Fort Lauderdale. So we haven't really seen any Florida metros on here yet, and I hope that changes soon, because Florida is definitely being absolutely stubborn. All right, guys, so let's start visualizing some of this data, and I'm going to start with median sales price. And remember what I'm saying, you guys. I'm saying in 2 more weeks, the whole narrative, it's not going to crash, we're in recovery, it's gone. Because as you notice here, the orange line, okay, so the orange line is 2023 median sales price. The red line is 2022. And what happens, guys, is if that orange line goes under, like I suspect, it's going to go under. Let me change the color on my pen, actually. So if this orange line does not keep this pace right here, if this does not keep this pace with the red line, you guys can see that, we're going to start having massive year-over-year price decline. So as you guys can see here, we are very close right now from being under that red line. Now, what I suspect is going to happen in 2 more weeks, I've called this, I don't know how long I've called this, 2 more weeks, you guys, I suspect that orange line, instead of having that trajectory that you see going up, here's the trajectory that it's going to happen instead. It's going to go like this, and I believe what's going to happen is it's actually going to start going down instead of up. And maybe if we get lucky, you guys go under 2021. Now, obviously, we want it to go all the way down to under 2020 values, right? I don't think it's going to be that sharp a decline unless we have, black swans or additional systematic failure in our housing market. But the interesting thing is we are extremely close, you guys. Let me remove that. We're already close, you guys, to having a national average of year-over-year price decline. So keep your eyes on that orange line. Let me show you guys the next thing. Now take a look at this, y'all. This is also very interesting. Let's look at median asking price. So here's the thing. Median asking price usually leads median sales price. And I really want to kind of point out that median asking price, y'all, is already faltering. You guys can kind of see here, this curve right here, it's already faltering. In order for us not to have year-over-year price decline, median asking price has to keep pace with the red line. It's not, you guys. Now that interest rates are higher, remember, interest rates are higher now. The bad trends or the trajectory of these trends should only increase and get even sharper. So what I believe is going to happen to median asking prices is probably going to stabilize and start going down. So that's what I believe. Maybe not as sharp as I just drew right there, but I definitely believe median asking price is going to go down. We're already seeing, some new build communities have to lower their prices under resale value. Let me show you guys the next chart. And here's the real issue right here, y'all, which is the mortgage payment. So, the thing is, here's where the mortgage payments are right here. Here's where we were at in 2022. Here's where we were at when you could argue some fundamentals were there, even though 2020 and 2021, the fundamentals weren't there. But this is where we should be. We should be way down here, you guys, with mortgage payments. Our average mortgage payments across the nation should be under $1,700, not where it is right now, which is $2,428. So the thing is, guys, again, we're going through an unaffordability crisis, right? We have an unaffordability crisis, and that is exactly what we're seeing here. Mortgage payments, you guys, they're just too high, even for investors. A lot of people think investors are going to save us. They will not save us because they can't. They don't even have the option. Let me go to the next one, which is inventory and supply. All right, guys. So here's the months of supply. Now, as you guys can see, we are at 4.1 months. So here's the thing. All of these people that were so optimistic and cheerleading the housing market in Phoenix is okay, the housing market in Las Vegas is okay, are wrong. We still have a tremendous amount of growth in months of supply. So again, I cannot believe how quickly these people flip-flop into a different narrative. Shocking to me. Anyways, you guys, it is up week over week to 4.1 months of inventory. And remember, we need 6 months for it to be considered a buyer's market. Although I'll say right now, it's a buyer's market. Even though it doesn't show in that months of supply, I'm going to tell you guys right now, if you are out there purchasing, you better treat it as a buyer's market and lowball everything effectively, right? But nevertheless, you guys, inventory is shooting up, or months of supply is shooting up, and it is well over, as you guys can see here, it's well over 2021 and it's well over 2022 inventory levels. So we're way higher right now. We're way up here, as you guys can see. Okay, so here's one of the leading indicators as far as what are the rates doing to the market. So in my opinion, we're going to start seeing this shoot up. But right now, as far as listings that had price cuts, we're at 5.1%. So we're more than double where we were at, in every other year that this is occurring. So here's the last 3 years. So the last 3 years listings with price cuts was way down here, right? So way down there. I'm sorry for my arrow, you guys. I'm still trying to get used to this iPad, so I can't draw too well yet. I need some practice. But it was way down there. We're way up here now, as you guys can see. So we're way higher than we were for the last 3 years. We're at 5.1%. Now, what's interesting is this kind of started going, downward, right? Which is what I was watching. But now that interest rates are, high again, this is what I think is going to happen. The further that we move into spring, this is what we're going to see. We're going to see that go up like that. So I believe, as long as the interest rates, keep going up and the 10-year stays high, that's the pace that I believe we're going to start seeing listings with price cuts. Okay, so let's talk about demand, and then we'll finish this up and we'll do our comparison. So here's where we're at right here as far as demand. We are down 22% year over year. So I just really want to bring this up, you guys, because I want you guys to understand the cheerleading and the narratives out there. Because quite frankly, we've been hearing, all over the place, the market's coming back. It's all, it's healthy. It's great. Everyone go buy before it's too late. But the reality is the demand is just as crippled as it was at the end of 2022 and the beginning of 2023. I mean, we see that right here. Here's where we ended. Okay, so this is where we ended 2022 as far as demand. So you can pretty much see if we draw a line from here to here, right? We can kind of see that it's about the same. So demand is the same. And the reason it's the same, the unaffordability is still crippling. I'm just saying, you guys, you have to definitely put this stuff in perspective and also understand what's going on with the Federal Reserve. But now what I want to do is I'm going to pull up a peak versus current comparison. So I'm really hoping to drive home how important it is to wait and how important price is versus interest rate. So what I'm going to do is this. So in June, which was essentially the peak, let me move this out of the way. Okay, was essentially the peak. The median sales price, you guys, was $390,000. Okay, so $390,000 average according to Redfin. Now rates back then were at 5.78%. Okay, now currently we're at $346,725. Okay, with the current average interest rate of 6.32%. All right, so 6.32%. All right, so those are the numbers that we're going to do. But before I do, I first want to just point out this one thing, and then I'm going to go into the payment. I want to show you guys how much money you would have saved roughly if you would have waited. So what we do is we take $390K or $390,000 minus $346,000. So if you guys waited, you would essentially have saved on average, okay, $44,000 if you waited. Okay, that's just if you waited. But now, you guys, let's compare mortgage payments, because as you guys know, about 75% of the transactions are purchased, our homes are purchased with financing. So let's see how much money we would have saved. All right, guys, so now obviously in order to do that, all I'm doing is I'm going to Google, as you guys can see here, and I'm just putting in mortgage calculator. All right, and now this is going to come up. Now, I just want to show you guys real quick. If I click this button right here, I'm able to put a lot more information in here. Look at this: property taxes, which I could usually get from MLS, homeowners insurance, and will automatically calculate your private mortgage insurance. You know, go to your loan officer, but I just wanted to show you there is actually a lot of details here. So you can get a lot of information, but let's unclick this and let's just see where we're at, you know, at the peak at 390,000 at an average interest rate of 5.78. You guys probably know this by heart now, but we're going to have a payment of $2,283. So $2,283 would roughly be your mortgage payment if you purchased in June with the lower interest rate. Okay, so even though we're saving, we already know we're saving $43,000. Okay, we already know we're saving $43,000, but if that wasn't enough, let's go again, look at the payment. So right now, at the peak with the lower interest rate, $2,283. Now, let's see where we're at today. Let me take the median sales price. Again, not the loan amount. We're just using the median sales price. So everyone relax. So we're going to take the average interest rate, which was 6.32, and that gives us a payment of $2,151. So even though the interest rate was higher, the payment is lower. And the reason why is because price is more important. Price is more important, you guys. So let's see how much money we save. Let me just bring up this simple calculator right here. Let me clear that. I do a lot of math, obviously. And all we're going to do is we're going to take the peak payment of $2,283 minus where we're at right now, which is $2,151. So you guys save right now with the higher interest rate. Listen, with the higher interest rate, you save $132 a month. But let's see a little bit, but let's take a bigger look at that. Average person owns their home, let's say 7 years. So let's time this by 12 months. That means our yearly savings, $1,585 times 7 years gives us $11,000. But we also have to add what we already know we're saving, which was roughly $44,000, which means if you got financing and you waited to right now to purchase, you have a savings, roughly a 7-year savings of $55,000. So I think it's worth, I think it's a little bit worth, just stopping a little bit and thinking to yourself, should I wait in hopes that I can save $150,000, right? And that's why I might push my lease back. It's super heartbreaking. I don't want to do that. It's my primary residence. I don't look at it necessarily as an investment. There's mental health involved as well. There's different reasons to buy. But the thing is, even having said all of that, you guys, I think that this is going to be I think this is going to be prolonged. And in conclusion, the reason why I think it's going to be so prolonged is people are fighting the Fed. I think that if the 10-year would have stayed above 4% and rates stayed above 7%, we would not have to do so much flip-flopping. And essentially, the Federal Reserve could continue their job at resetting the housing market, which is not easy. That's horribly sticky inflation. But nevertheless, you guys, that didn't happen. The market rallied. The market keeps fighting the Fed. And as a result, we're going through this flip-flop. Anytime they step off the gas, people run back into the market. It's the craziest thing ever. As a result of that, I may wait to 2024. I don't know that yet, guys. I will be completely transparent. I don't know 100%. I'm going to do a live video on Saturday, and I'm going to go into more about my home buying journey. So stay tuned for Saturday's live video. Now, other than that, guys, I hope you guys got some value, insights, and perspective in today's video. And if you're out there investing in real estate, I wish you luck, and I hope you win.